Welcome back to Ground Up Accounting. Now, last time, Ground Up Coffee ceased to be an idea and became a business. The owner invested $50,000. We opened our books. We discovered that accounting's first great trick is that nothing ever appears from nowhere. Every dollar has a source. Every transaction has two sides. The books remain in balance because reality insists upon it. Today, however, something rather more interesting happens. Our business begins spending money. And this is the point where many enthusiastic entrepreneurs experience their first brush with reality. They've spent months dreaming about customers, profits, and success. What they didn't spend quite so much time dreaming about were invoices, because before you can sell coffee, you need somewhere to make it. You need coffee beans, milk, cups, packaging, equipment, suppliers. In other words, before a business starts making money, it usually becomes remarkably efficient at spending it. Ground Up Coffee is about to discover exactly that. One of the biggest misunderstandings in business is the word credit. People hear the word and immediately think of credit cards. That isn't what accountants mean. Cash simply means you pay immediately. Now, whether that's with a bank transfer, credit card, physical notes, or even a credit card, it makes no difference. The supplier has been paid. Credit is something entirely different. Credit means you receive the goods today and pay later. The supplier trusts you, which is a wonderfully civilized arrangement, until somebody forgets to pay. Now, most businesses spend a large part of their lives buying on credit. It improves cash flow. It allows businesses to grow, but it also creates obligations. And accounting has a rather irritating habit of insisting we record obligations whether we enjoy acknowledging them or not. Ground Up Coffee orders its first coffee espresso machine. So the supplier sends an invoice. Now, the machine is going to cost $10,000 and the sales tax is going to be $1,000. So our total invoice, $11,000. The payment terms are going to be 30 days. Now, notice something important. The coffee machine arrives. The invoice arrives. The business now owes money, but not $1 has left the bank. This is why accounting distinguishes between cash and credit. The transaction has happened. The payment has not. Now, think of an invoice as a formal IOU. It says, I've supplied these goods. This is what they cost. This is when I'd like to be paid. Now, an invoice is not a payment. An invoice is evidence that a financial obligation now exists. And that obligation appears on our balance sheet as a liability called accounts payable. Now, different countries call it different things. VAT, GST, sales tax. The name changes. However, the accounting principle does not. For simplicity, throughout this series, we'll assume a 10% sales tax. So whatever your country calls it, the bookkeeping follows the same logic. Now let's think about that coffee machine. Did we spend $10,000? Yes. Is it an expense? No. That catches people out all the time. If we treated the entire machine as an expense today, this month's profit and loss would look dreadful, while the next 5 years would enjoy the machine for free. That would hardly be a fair representation of reality. Instead, accounting says this machine will help earn income for several years. Therefore, it belongs on a balance sheet as an asset. So let's look at the journal entry of purchasing the coffee machine. So as you can see, we have 3 new accounts to consider. The coffee machine, which is an asset, the tax recoverable, which is a liability, and the accounts payable, which is a liability. Now don't worry too much about liabilities at the moment. We will cover them in detail, but just notice the journal entry here, the debits and the credit side. So our coffee machine is debit $10,000. Our tax recoverable is sales tax is $1,000, and when we post that to our accounts payable, that's $11,000. Now, notice what didn't happen. The bank account hasn't changed. No cash has moved, and our liabilities have increased. Now that is the power of buying on credit. Now comes one of accounting's more beautiful ideas. Now, assets grow old, machines wear out, furniture gets scratched, buildings deteriorate, time, as it turns out, invoices all of us eventually. Our coffee machine cost $10,000. Now, we estimate it will last about 5 years. That means its cost should be spread over those 5 years. So that is an annual depreciation of $2,000. Okay, 5 years divided by 10,000, that's 2,000 annual depreciation. So, but throughout this series, we'll prepare our accounts monthly, not annually. So each month we'll recognize a depreciation value of $166.67. Okay, so 166.67 every month for 12 months is 2,000 euros. So we're breaking it down because we're reporting our accounts every month. So that way, each month's financial statements tell a fairer story. So at the end of January, we'll record the following. Journal. So have a look at the accounts we've created. So we have something here called a depreciation expense. Now, expense, remember from episode 2, an expense is a profit and loss item, and we'll find that on our P&L. And we have something here called accumulated depreciation, the coffee machine. The accumulated depreciation of that machine over the month will amount to $166.67. Our depreciation expense will be posted at $166.67 to balance our journal. Now again, notice that no money leaves the business. Depreciation is not a payment. It is simply accounting recognizing that 1 month's worth of the machine's useful life has been consumed. A coffee shop without coffee is merely an unusually expensive waiting room. So we purchase our first inventory or stock. So we buy some coffee beans, that's going to cost us $2,000, milk, which is going to cost us $500, some cups, which is going to cost us $300, some packaging, which is going to cost us $200. So that's a subtotal of $3,000 in total. We're going to add the sales tax or the VAT or the GST or whatever country that you call this of at 10% at $300. So our total invoice is $3,300. Now again, we've purchased these items on a 30-day credit. Again, no cash leaves the business. So let's look at our journal entry for our stock or inventory purchases. So we have a few more accounts to note here. So we've created this inventory or stock account on our balance sheet. We have $3,000 worth of stock. We've collected $300 worth of tax, VAT, sales tax, and the total amount that hits the accounts payable account, the credit side, that liability is coming in at $3,300. Now, Ground Up Coffee, it now owns inventory or stock, and Ground Up Coffee now owes another supplier. Now we're going to enter both invoices into our accounting software. So we'll create our new accounts. So in our assets register on our balance sheet, we now have a coffee machine, we now have inventory, and we now have tax recoverable. On the liabilities end of it, we now have accounts payable. In our expenses, we now have a depreciation expense. And we have something called, we'll call it a contra asset. This is the accumulated depreciation of the coffee machine. Notice how our chart of accounts is growing naturally. We're not creating accounts because an accountant told us to. We're creating them because the business now needs them. The software is simply recording the story. Exactly the same story would be recorded in Sage, Xero, QuickBooks, or GNU Cash, the program I'm working on. Remember the driving analogy from episode 2. You don't learn Mercedes, BMW, Mini. You learn how to drive. And accounting software is the car. Double entry bookkeeping is the skill. So let's look at our chart of accounts. So we have bank in our assets, we have bank, coffee machine, inventory, tax recoverable, and something called accumulated depreciation. In our liabilities, we have accounts payable, we have in our equity capital, we have owner's capital, and in our expenses, we have depreciation expense set up. Let's have a quick look at our trial balance just to make sure our debits and our credits are matching, and they are. We can see their bank, coffee machine, inventory, tax recoverable, the depreciation expense, all totaling $64,466.67 on the debit side. And on the credit side, we see the accumulated depreciation recorded, plus the accounts payable, remember the suppliers who we owe money to, plus our owner's capital. And that balances out quite nicely at $64,466.67. Let's have a quick squint then at our profit and loss. So as you can see, our revenue still haven't sold any coffee yet, but we have recorded the depreciation for our coffee machine for the month of January. So we have a net loss there. And then let's have a quick look at our balance sheet. So we have $50,000 in our bank. We now have an asset, the coffee machine, of $10,000, less the accumulated depreciation of $166.67. So the net coffee machine at the end of January is $9,833.33. So just note that every month that will be going down by that amount every month. We have inventory of $3,000, and we have tax, the VAT or the sales tax, of $1,300. So there's our total assets. And let's look at our liabilities. Yes, there is the accounts payables that we owe, the suppliers that we owe money to. And there is our capital. Now notice there, so our owner's capital, $50,000 that we put in at the start of the business. But look here, current year loss. So that is taken into account the depreciation loss in the machine. So can you see how total equity now is at $49,833.33? We can see then our accounting equation still balances perfectly. Now, today, Ground Up Coffee bought its first equipment. It bought its first inventory or stock. It met its first suppliers. It received its first invoices. And for the first time, the business owes money to someone other than its owner. Oddly enough, that's progress. Real businesses don't begin with profits. They begin with preparation. They invest, they build, they acquire the tools they need. Only then do they open the doors. And that's exactly what we'll do next. In episode 4, Ground Up Coffee finally welcomes its first customer, issues its first sales invoice, collects its first revenue, and we discover that making a sale is rather more complicated and considerably more interesting than simply taking somebody's money. I'll see you then.